Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be providing this week's topic, which is titled 3 Core Strategies Every Retiree Must Use. And my goal in this presentation is to look back and review the special presentations I've had the privilege to share on behalf of Retirement Services over the past 9 months. They have all had to do with these 3 core strategies we're going to talk about. Now, I'm going to look at the current status and performance of some of the portfolios we looked at, and we're going to take a look at a recent case study. So let's go ahead and jump right in. The special presentations I'm going to address began back in June of 2017, where I did one called How I Fell in Love with High Relative Safety Stocks. So I'm going to go ahead and start there. If we jump into the program, right from the home page, I'm going to go to the Unisearch tab. And when I talked about falling in love with high RS stocks, one of the key reasons was when we look at the graph patterns of these type of stocks. Remember, we focused on relative safety. That's the consistency and predictability of financial performance of a company. And when we look at that company that does make money quarter over quarter, year over year, here's what we see when we take a look at those graph patterns. So if I run the search Worry-Free Winners, which is based on relative safety, high RS stocks, sorted by relative safety, I can go ahead and click over and we can take a look at some of the values here. We have some very familiar names, AOS, perhaps my favorite stock in the entire database here, and we've got our proprietary indicators that I talked about in that strategy, that when you see relative safety numbers at this level, which are all considered excellent in the VectorVest scale on that 0 to 2 basis, that we see that all of the other numbers fall into place. Relative value, relative timing, the value safety timing indicator, the comfort index, they all fall into place generally speaking when we see relative safety numbers this high. And so the reason that we fall in love with these type of stocks is because when we look at the graph, we can visualize that consistency and predictability. And I like to say, what 2 better adjectives are there than to describe the stocks that reside in your retirement portfolio? And if I go ahead and add earnings per share to the subgraph here, we can get that beautiful picture of this lower left to upper right movement on these stocks on both price pattern and down below. This is the earnings per share as calculated in the VectorVest program. I'm going to go ahead and take this back to 5 years just to enhance the quality and the power of these type of stocks. So if I scroll through those top 10 from the search, again, there's AOS, the earnings per share on that steady upward plane, HEI Corp, and I'll just scroll through and you can get the sense that these high relative stocks result in this type of performance over time. And this is why we fell in love with high relative safety stocks. Again, that was back in June of 2017 that we presented that particular special presentation. I said then that when you fill your retirement portfolio with stocks that have that type of performance and that type of graph pattern, what we can hope to realize are results that look a lot like this. So if I open up just one portfolio here called the Worry-Free Winners, this is a 5-year look back on that portfolio. We're up over 93, almost 94% as we speak, looking for those high relative safety stocks, some great performance, and keep in mind that these results do not include any dividend payouts. All of these stocks pay a dividend, and this return does not include those dividend payouts. And so that's the beauty of when we're looking at that first core strategy or technique of capital appreciation in our retirement portfolio, and that was the focus there. If I go back to our slides, again, that was on June 17th, 2017. I followed in with a strategy called the Blue Chip Dividend Payers. The Blue Chip Dividend Payers was a search that we created so that it would make it easier for our subscribers to go in and simply find stocks that met a certain parameter that allowed us good quality, mature, stable companies that reside in the Dow Industrials, Transports, Utilities, or the S&P 500. We said then that the dividend yield has to be at least 3% or greater. And we took them from a watch list called the DRIP watch list, either the 10 to 24 years or the DRIP 25 plus. Remember, that's dividend reinvestment plan. The stocks making these watch lists have not only paid their dividend every year for 10 to 24 or 25 or more, but they've grown that dividend every year. And so that characteristic has to be in place to make the list. And here's one tweak that we've made since that strategy, and we've gone ahead and added a very important parameter. Now the sort gives us growth rate times dividend growth. So we want to make sure that the stock's earnings are growing and that their dividends are growing, and so we bring that combination to the top. But in a later strategy, I talked about building a strong dividend growth portfolio, and we talked about payout ratio and the dividend yield versus the earning yield, and how important it is to find stocks whose earnings yield is greater than their dividend yield, because otherwise how are they going to continue to pay out more in dividends than they're actually earning? And so we added the dividend safety number. In VectorVest, that's a proprietary number on a 0 to 99 scale. Anything above 50 is considered good on that scale. So if we take a look at some of the stocks that come up, again, we've got some recognizable names. We get utilities and REITs and other, again, well-established companies. And when we focus on the dividend safety numbers that are above 50, what we can assure ourselves of is that the earnings yield is going to be greater than that dividend yield. And that's important. Again, if a company's paying out more than they earn, when the economic headwinds come or any kind of hurdles specific to the company, they're going to have a harder time paying those dividends. And there is no greater black eye for a company than to have to lower their dividend payout. And so we added that to our list. And so now when we see our dividend safeties greater than 50, we can see our earnings yield greater than our dividend yield. And that's the key that we're looking for, that earnings yield greater than the dividend yield. And we can assure ourselves of that when we focus on the dividend safety indicator. And so we also have a portfolio that's tracking the blue chip dividend payers. And if I go into that blue chip dividend payers portfolio, we can see the current list of stocks that resides there. If I click that top stock and tag these, let's go ahead and take a look at the stock graphs of these type of stocks as well. So we'll start with T. Rowe Price. I'm going to put on the subgraph the dividend payout history, and I'm going to go ahead and take this back as many as 10 years for each of these stocks, and you can see that nice staircase of a growing dividend payout as you progress through. And if I scroll through, we'll see a very similar pattern on all the stocks that currently reside our blue chip dividend payers portfolio. And again, we can see that nice steady staircase, some familiar names. Again, we've got REITs, we've got utilities that come into play. Some very common names have in the history of this portfolio been in there. Lockheed Martin, McDonald's, Johnson & Johnson, are all companies we see. So when we fill our portfolio with those type of stocks, again, here are the results. And a very important piece of information here for us all is that this equity curve and the return of over 80% over the last 5 years does not include the dividend payouts that we have received. They've not been added into this portfolio, but there are over $22,400 worth of dividends that have been paid out, that I've calculated out over the years and over the positions that have been held here. So you've got a portfolio that's more than doubled over the past 5 years. So some great results, and that doesn't include two other things. That doesn't include the idea that you could be reinvesting those dividends and thereby compound that return. And it also doesn't include the ability to sell covered calls throughout periods like 2015 when the S&P 500 was actually down. And you could have generated even more income by selling covered calls against these positions. So we talk about that in that particular presentation, and that's core principle number 2 that every retiree must use. So we talked about capital appreciation, and now we're talking about income based on the dividend portfolio that we've created here. On December 15th of 2017, we did a presentation called Capital Preservation in the VectorVest System. And here we talked about specific ways, strategic ways that you can protect your retirement portfolio, from covered calls to protective puts as insurance, to combining the two to create a collar trade where you sell a covered call, use that premium to insure your portfolio or insure a specific position. It can be done on either an indexed ETF like SPY or the Spiders, or it can be done on your individual stocks. And there we showed a couple of examples, and what I'd like to do now is just show another more recent example, a case study of Texas Instruments and how important it is to be able to protect your portfolio, to strategically know when it's important to initiate that insurance. You've got to have that policy in place at the right time. And so we built a case study here. Texas Instruments, a high RS stock, a confirmed up call came in our case scenario here on 11/24 of 17. If you were to have gone out and purchased 100 shares of Texas Instruments, you would have paid $99.30 near the close of trading that day. Now the stock did exactly what we wanted it to do, right? It went straight up, great return. It traded right around 120 in January of 2018. Now, a week before earnings, and this could be a week, 10 days, 2 weeks, but we always do our due diligence on the stock, and we have to know when reports are coming out. So in this case, 1 week before earnings, TXN closes at 119.16. The return on this date is $1,986, or roughly 20% return from November to January. The idea here I'd like to emphasize is that when you purchase a stock and you do everything right and that stock goes up to 120, my mindset, and the mindset we want you to take, is that you no longer own that stock at 99, but you rather own that stock up at 120, and it's incumbent upon you to react. Now, one answer is to just go ahead and sell the stock. Stock is rising. The market was still in a confirmed up call. There really was no reason at that point to sell the stock, but that is an option. You could sell the stock. The other technique you can use is simply go in and buy a protective put. In other words, put an insurance policy on the stock. And here's what it would have looked like. So with TXN trading at 119.16, 1 week before earnings, that was January 17th of 2018, you could have gone out and bought an insurance policy. In this case, we'll use the February 120 strike put option. So basically an at-the-money put. It would have cost you $4.23 per share. That's $423 for one contract to insure an asset that at that point is worth $12,000. Well, here's how it turned out. Had you bought that put at $4.23 with the stock trading right up around 120, what happened was on 124 before the bell, Texas Instruments announced earnings and the stock gapped down. It traded as low in the life of this option as 97.66 on February the 8th of 2017. On February 16th was the expiration date for that put option. TXN closed at 104.47. The February 120 put was valued at $15.53. That's a profit of $11.30 per share times 100 shares, or what comes to one contract, is $1,130, or 267% return on your option contract. So all we've done here is mitigate a big loss, a big drawdown based on news. And here's the beautiful thing. I don't have it marked here, but there was another dividend payout that you would have received from Texas Instruments. Because it's a high RS quality stock, yes, even those stocks can go down, by the way. But when we are proactive and we prepare for those announcements and strategically place these trades, not only did we mitigate the loss to the downside, but we were able to hold on the stock if you chose to. You had the option of actually holding on to the stock. Now, you may not have, but if you did, again, more evidence that good quality stocks will rebound. They are resilient, and the stock trades now roughly around between 108 and 110 just a few weeks later. So that's a powerful tool to have in your toolbox to be able to place that insurance premium here. And then the questions I often hear after that presentation, or when I talk about the protective put, is, well, what if I just had a stop loss? I didn't have to spend money. I could have just had a stop. Well, this is why we use the protective puts, because that stock gapped down. So if you had a stop order in somewhere around 115 or somewhere between that and 120, your stock would have gotten taken away from you way somewhere down here. That market maker would not have offered you a very fair price up here. So you would have gotten hurt there. And again, the ability to hold on to the stock and mitigate that loss as it's moving down is a great weapon to have. So that's just kind of a quick review and an update for what we've been doing in retirement services. Again, focusing on the 3 core strategies of capital appreciation by finding high relative safety stocks. Core strategy 2 is the income portfolio, where you can generate income through both dividends and covered calls. And then finally, and perhaps most importantly, is that ability to know how and when to place the insurance policy on your portfolio. Now, what we've done is we've put all of these core techniques under one umbrella that we call the ultimate retirement solution. It allows you to keep making money while you enjoy life. After speaking with Dr. DeLito about what we can do for our subscribers who are either entering into or approaching retirement, or for those who are already there, and there's that big fear that how do I keep from running out of money in retirement? Well, as I posed that question to Dr. D, he gave the response that the best way to not run out of money in retirement is to simply keep making more money. And so, again, we've put it all together in the ultimate retirement solution. It's going to be streamed live from Phoenix, Arizona on March 23rd and 24th, 2018. You have the ability to enjoy this from the comfort of your home or office, live streamed to you. This will be recorded, this 2-day session, and the link will be sent out to you where you can watch it, rewind, pause it, and make notes, and you'll have access to that recording. At our Ultimate Retirement Solutions seminar, we're also going to introduce a growth portfolio focused again on high safety stocks. This retirement growth portfolio and search and trading plan that goes with it has performed really well. We're going to introduce that at our Ultimate Retirement Solution course. And also we're going to look again at the retirement income portfolio. This is a portfolio that focuses on covered calls, doing a buy right, 1 trade per week. For the last 3 years and 3 months that we've been managing this portfolio, it started back in January of 2015. We're up over 63%, or a 20% annualized rate of return, 83% winning trades, again, all by doing just 1 trade per week. Sign up for the Ultimate Retirement Solution live stream, and we're also going to add in a 4 bonus implementation webinar series for you. Once a week for 4 weeks, we're going to get online with you during market hours, and we're going to go ahead and build and manage a retirement portfolio. We're going to do 4 of our buy right or covered call trades for our retirement income portfolio. And so we're going to walk through that during live market hours, and that's a bonus for you for signing up for the Ultimate Retirement Solution. You can type in this link, www.vectorvest.com/URS for Ultimate Retirement Solution, and there you can get to our registration page for more details. The Retirement Solution course regular price is $495. We do have a special price. You can save $50 and pay just $445. That offer does expire Tuesday at 10 a.m. Eastern Time. So again, go to vectorvest.com/URS and join us for our live stream event from Phoenix, Arizona on March 23rd and 24th of 2018. And that does it for this week's special presentation. If you have questions on this or anything else related to VectorVest, please don't hesitate to call 888-658-7638. And thanks for taking the time.